Hi traders, this is Houston Strong from thetradingedge.org. In this video, we're going to talk about how to identify and catch major market reversals like the one we had this past week on the North American equities and indices. So what we're going to talk about today is how to use a combination of price action and market internals to allow you to time these great trading opportunities, because the most amount of money is made during these transitions. And so in this video, I hope I am able to share with you a few things as well as some examples to help you with tactics and strategies around the understanding of the market mindset that's happening around these turning points and sort of the more basic building blocks of price action that will help you identify these turning points. So as I mentioned already, I use two primary tactics to identify these turning points or these reversals. First off is a very clear understanding of price action and what's happening across these major time frames, and secondly is the use of the understanding of market internals. And so what does market internals mean? So what's the definition of that? Well, you can identify market internals a number of ways, but as a definition, market internals is simply a way for you to identify the strength of the underlying components inside of a market or index. So we're looking at the SPDR ETF here, the S&P 500 ETF, and that's obviously comprised of 500 companies. And so by looking at the internals, we're simply talking about identifying at a granular level the strength of the components of the S&P 500. So this works on on any index. So you'd have to find the right market internal indicator, or you'd have to find the right method to try to identify some of these things. But there's various different ways, and I'll share with you the one that I use on the SPY. There are others like you can use the NYSE tick for for the S&P. You could use the TRIN for the Nasdaq. You can use the McClellan oscillator. There's a number of them you can research out there. I'll show you the one that I kind of favor and use, and you can perhaps add that to your trading tool belt. So let's start there. So the market internal indicator that I like to use most, or that I track regularly every day, is one called the S&P 100 number of stocks trading above their 50-day moving average. That one's called the S1FI index. So it doesn't show up on every single trading platform. I'm using TradingView here, but if you type in S1FI on your trading platform, you may have it. If not, you can Google it and you can find the data on other websites. And it's usually end-of-day data. So it's the number of S&P 100 stocks currently trading above their 50-day moving average. So basically a percentage. Okay, so I've overlaid that particular index on top of the SPDR chart. So SPDR's showing up as candlesticks, and that blue line here, this blue line, is the index that we just talked about, the S1FI. Okay, so let's talk about this indicator for a few moments here, and I'll give you a bit of history on why I was looking at it and at the turning points where I was looking at it. So a couple weeks ago, at the mid-February, it hit a really high rating. We were at one point up around at 91%, around the 91% range, and that means that 91% of these stocks in the S&P 100 were trading above their 50-period moving average. And you have to go back a long ways before you see that condition. So let's go back here now. So S&P 100 above 91%. You'd have to go back quite a ways. And in fact, the last time we had a number that high, or reading that high, was way back here. Back in January of 2018. So back here we actually hit a number of 93, and then if you look at the chart, you see what happens here. If you recall, at the end of January into February, we had that big dip when we had that big VIX explosion, and obviously the indices really corrected over the course of those 2 weeks or so. And so you really had to go back that far, basically a little over a year, before you had a reading that high, and the result was something like this. So let's go back to the present. And what caught my eye, not only were the elevated levels, as we saw here at 91%, but that they basically flatlined. right? So we had 1, 2, 3, 4, 5, 6 trading sessions where that value did not change. And that was very odd because I do track this number every day, and to see it not change for 6 sessions, I was wondering if the data was not being refreshed or not, because it's it's quite a long time where you're used to seeing the number move every single day. Here we had, again, 6 sessions with the number basically flatlined. Then all of a sudden it popped up that day on the 26th, but we had a divergence in terms of price action. So the markets actually went down and then all of a sudden, the index kept going up. And then the following week, this thing kept going down, but then the markets started to climb up, right? So here we have a divergence, a bearish divergence, where you have price action going higher, but you have fewer S&P 100 stocks above their 50. Okay, so that's a real bearish divergence, because that tells you that fewer stocks are participating in this rally. Now, this in itself is not enough to put on a short, right? Because if you just take a signal, if you just try to take a trade off of this alone, there's no timing involved there. So if you see this happen here and you decide to put a short on around here, right, because you see it dip all of a sudden, you decide to take a short, then this happens and now you're underwater, right? So let's say you put a short on this day here or that day because the bar's red, and then it pops up. Where do you put your stop? Do you put your stop above here, 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 here? Well, it popped up above all these 2 bars, and this day here it pops up above that, and now you're underwater, right? And when do you cover? Where do you cover your short if you're short here, right? Or if you bought puts, what do you do? And so you need to time the entries better, because this, you're simply shorting without using price action, is a recipe for poor timing. So I will now move on to the understanding of price action, because that's exactly what happens the next couple days that allows us to get into a trade at a far better and choice opportunity than simply shorting here. Now, actually, before I get into price action, let's just go back a step here, and I'll give you another history of this particular index. So we saw the 91% and how high of reading that was. Let's take a look and see what happened back in October. If you recall the sell-off that happened back in October, we also had an interesting example that's worth pointing out here. So here is October. If you recall, October, the 1st of October, the first week of October is where things kind of really broke down for the S&P, and that's kind of what started this landslide down and down and down until the month of December. We bottomed on the 24th, 25th, right around Christmas time. Now, if you look at the index going into this first week of October, you can see that we have a real divergence here, right? So I drew the line in ahead of time, but it really peaked out back in August, the 29th of August. Actually, it was right here, the 27th of August, and we start getting lower lows in terms of this index, right? So that means fewer and fewer S&P 100 stocks are above their 50, yet price action keeps going higher. In fact, here we're making new highs, right? Here we're making new highs, and then it keeps dipping lower and lower and lower. And here in the month of October, this is the month right here, October the 1st, we have an inside bar. Sorry, this is the second. We have an inside bar. It breaks up to the upside, and the next day they actually gap down. So anyone who got long here, thinking that things are going to keep going higher, they get trapped if they buy this breakout, thinking it's going to be a breakout. It's going to be a small pullback and a breakout. They get trapped when it gaps down, and the rest is history. If you didn't cover, you're in big trouble, and you're in a pain trade. Okay, so again, looking at that particular index allows us to have a better understanding of the components inside the index. So now we're going to combine that sort of bias that you can create with that index with an understanding of price action. So let's look at the price action charts now and drill into what we saw happen this past week. So bottom right hand corner, we have our monthly chart. Bottom left is our weekly. Top right is our daily. And top left is our 2-day chart. And I'll interchange the 2-day with the 4-hour to also give you some different looks at the price action. So starting at the highest level first, right? So we have a brand new month, and because it's a new month, it's very important to watch the open of new month, because the opening of a new month and new week is a chance for sellers and buyers to try to seize control. We have when you have a brand new month, especially, it's basically a restart. It's a reset. It's the start of a new game, and whichever side comes out swinging harder can take control in those opportune moments of the opening match. Okay, so it's very important to watch and see what happens in the beginning few sessions of a week and of a month. And so the month of March, the bears or the sellers took over very quickly. So we have a red month that happened very quickly in March. Now, in terms of the weekly, we want to be watching that, because the weekly has exhibited a lot of strength. Prior to these past 2 weeks, the spider had I think it was 8 consecutive green weeks. Was it 1, 2, 3, 4, 5, 6, 7, 8, 9 consecutive green weeks, starting all the way back to, to the last week of December, right? And so it had 9 consecutive green weeks. But as you see here, if in order for a reversal to happen, you need to see at least one of these weeks turn red, and you want to see one of the lows get taken out, because that's what a reversal looks like, right? That's what a reversal looks like, is when you start to come back through the range and going back through other people's stops, and that's when you start to get major reversals. Now, also bear in mind here that the week prior to this, the S&P had managed to break over this pivot of 280.40. So anyone here who had gotten short, right, back in December and was looking really smart when they put a short on, and they're trying to figure out where to put their stop, anyone who had left their stop up here and held it all the way from December, end of December, all the way to February, well, to early March, well, you finally got stopped out that last week of February, right? And in fact, in March, it went even a little bit higher to take out anyone who may have just trailed their stops above this particular level, right? So this is 281.22. The high here was 281.87. So even if you put your stop up here, you would have got stopped out, right? So the market, looking for liquidity, found everyone's stops who left it around those areas, and then again, the challenge for a market to continue would be, are there more buyers that come in to look for other stops that may be higher up here? For the time being, the answer is no. There's more sellers than buyers, but let's get back to our story here. So any major reversal will involve the breaking of a previous weekly level, because why that's significant was because, as I said already, that's when you start to go after larger pivots, right? Not just intraday pivots and daily pivots, but you're going after higher time frame pivots, and that means you're getting more time frame participants involved. So not only are you involving the day traders and the swing traders on the daily charts, but you're also getting involved the higher time frame traders who are trading more money and not looking at these smaller charts to make decisions. You're getting involved in people who have wider and wider stops, because they have more monies to allocate, and their positions are larger, so they can't get chopped up in these small movements. So going back to, let's go to the daily chart now. So I drew the level below last week's low, so the low of February 25th. I drew in that level there. That level is 277.48. Okay, so as March opens up, we have a day that gaps up. We talked about that already. It gaps up, so that's the daily. It gaps up. I'll just zoom in here so you see that better. It gaps up, and then the next day, it opens up and goes even higher, and it may have even triggered some people that even get more long, or get to buy sort of a breakout here, expecting these things to continue even further after breaking out this little small pullback. Okay, now what these people aren't seeing here is that this purple line is the weekly open, and the orange line is the monthly open. So it opens right there. They're able to break it above slightly higher, but very quickly it pulls back into the range. Once it pulls back into the range, it goes even below the monthly open. So now, once you're trading below these two areas, the purple and the orange line, now you have full time frame alignment to the downside, meaning the monthly chart is red, the weekly chart is red, and the day is red. So now you have these three participants, folks who are looking at the monthly, weekly, and daily, all seeing red charts. And this day ends up being an outside day, right? So it flushes any late longs and stops them out. And now you're at risk of it going back against you, against any late longs or weak hands who may have gotten long with poor trade location. So the next day, if you were trading it, you may recall, it looked like it was a kind of a bullish day. Buyers stepped back up again. It looked like the sellers could not break it down any further, and for the most part the day was trading green until near the end of the day where it turned a bit red. But for the most part it stayed in the middle of the previous day's session. Now if you're not recognizing this as a dangerous condition, then you're not doing your homework, because as I mentioned already, here you're in full time frame alignment to the downside, meaning it's a red day, a red week, and a red month and a red week. Purple is the weekly open. And so that means all these time frame participants are seeing the charts as being red. And if you're having a green bias at this point, or a long bias, your bias isn't correct, right? Because as soon as it breaks below this level here, then it's a breakout to the downside. The first pivot that people are going to go after is Monday's low, right? Because that's where you know people have their stops. Anyone who had bought this dip here, where would you put your stop? Below this low and perhaps below that low. So as soon as this low is taking out, that's the next target, because we know that there's going to be buyers. Well, that's going to be their last point of exit. This red line, if you remember, also is our weekly open. Sorry, our previous week's low. So once this low gets taken, once this red line gets taken out, that means we've even taken out the low of the previous week. So anyone who got long the previous week on this breakout, now those guys are going to be underwater as well, and they're going to be covering and adding to the selling pressure. And so this day breaks below that previous week's low, and then the subsequent day we have a gap down, trapping everyone who did not get out earlier, right? And now it's a pain trade, because for most of that day you're trading lower, and at this point if you haven't covered, you're trying to find a good graceful exit. Friday we had a bit of a relief rally here, and I talked more about that in the weekly analysis video that I put out earlier. You can find that on our YouTube channel and our blog site if you want to know more about the weekly analysis around what's going to happen perhaps for the coming week. So that's what the price action looks like, and we can zoom in a little even further here to the 4-hour chart to give it even a little more color. Okay, so here's the 4-hour chart now, and I'll just zoom in to give it a little more color. There's the Monday where we have that outside bar, right? So here is the Friday, the 1st. We had a gap up, inside bar up on Monday, quickly met with selling, turns into an outside bar, and anyone who gets long here gets stopped out in this sequence. The game gets reset here. Now, as a buyer, if you buy in here, where are you going to put your stops, right? So people see this inside bar. If they buy it, they're going to put their stops there and there. So it could have, walked a wall of worry and gone after this area here. But don't forget, as we talked about on the daily chart, this is trading with full time frame alignment to the downside, because not only is the month red because you're below the orange line, not only is the week red because you're below the purple line, but it's a red day as well. All right, because don't forget, you opened here. That was the daily open up there, and you went red. So here it's a red day, and you're buying this, and so you basically, if you're buying this, you're going you're countering all the trends. The next day it pops up a little bit, and it may have lured in some more buyers because you have a few higher highs, and then you have kind of a shooting star, maybe it's more of a doji, and once that breaks down, right, you get the selling pressure with the long tail, it breaks down and then it collapses. And so again, we know that their pivots are going to be here, and then after this low gets taken out, they're going after every subsequent low below that. Okay, so will we see more selling pressure? At this point here, we're kind of oversold just based upon how far we've gone already and kind of the bounce we're getting now, but there's no reason why we couldn't simply bounce back up against here again, and we have to basically reevaluate and see what the weekly open looks like and what the other time frames are doing to evaluate and see what the next opportunity is going to be. But that's how you identify a turning point, right? Where you're taking out various levels across time frames and it's lining up with the opens from various time frames. So in terms of a trading opportunity, a couple really good opportunities there. You had a lot of time to go after it by simply looking at the daily chart, right? Looking at the daily chart here, you had a lot of time to buy puts or to go short the spiders and put your entry right here. And there's tons of opportunity to get short here, because the good thing was that the markets did not gap, right? So had you put a short order here and had a gap down, you would have missed that entry. But this gave you plenty of time to get short the spiders. So I think a lot of people didn't have the feeling that it could go down that quickly, and maybe people were not panicking. But by the time these two bars set in, we had a lot more panic, and people at that point where we saw the gapping down of a price. Here it was a slow bleed. Then all of a sudden, we had that race to the bottom, as which you see when more panic sets in. So let's go back in time a bit now, and let's look at another example. Let's take a look at October sell-off really quickly, because I think it's also educational. So I like to go back and look at previous reversals to see and understand the market psychology on what traders were thinking and the trades that they were in at those turning points. So if we look back in October now, let's zoom into that daily chart. So we'll go to October, and we'll see what happens here, right? So here's the end of September, okay? We end up basically flat for a good 3 sessions. And then at the beginning of October, you see right there, it's the new week, new month. We immediately trade below the week and the monthly open. Okay, so opens, very weak. Basically does nothing, right? So it's low volatility. The next day we have a doji, inside day, and it pops to the upside. So people who are buying this breakout think that it's going to go higher. Immediately, the sellers come in and take it once again back below the weekly open and the monthly open. So if we do what we did with our last example, let's go ahead and draw in the previous week's low, because we're looking for corrections to happen on various time frames, right? So we're trying to identify a confluence of turning points. So if the low gets taken out here, the low of September 24th, then that's going to be a turning point, because that was an inside bar. If people buy this particular inside bar and it breaks to the upside, they will have their stops taken out and stopped out if that low gets taken out, or if that area around here gets taken out. Then people can go stop hunting for anyone who got long below those levels. So now that we know that level to be 289.41, let's go back into October's price action and see how we traded around that level. Okay, so let's zoom in once again here. Okay, so there's that level, 289.41. So here we were, inside bar, break to the upside, and it fails, right? So there's a reversal right here, and this is where people get trapped, right? So if you get long here, it's a gap down. So had you put your stop there or there or there, now you're in trouble, because it opens and immediately gaps down, and you're trapped here. And now you're trapped with full time frame alignment to the downside. And this bar immediately breaks the previous week's low, and now you know that they're going after the pivots not only on the daily time frame but also on the weekly time frame, because any major reversal, over here, is going to involve not just the lower time frame charts but the higher time frame charts. So the big reversals involve taking out the pivots for the higher time frames. So that's something you want to be watching out for. So as we had this, again, going back to the present, as we had this run up back into March, you can see that the ranges are getting smaller and smaller, right? Because the buyers are getting less and less aggressive. There are fewer new buyers coming in, so that means they're not able to push price as far as they had earlier in the rally. Earlier in the rally, we had really big bars, and as we move up here, the bars get smaller and smaller. And that's when the sellers have a chance of turning things around, because then they can begin to take out the lows of these previous bars to create these bigger turning points. Okay, so in a sequence like this, right, let's say like this here, it's very hard to make this bar red, right? So if you open up here, the next bar, how are you going to turn this bar into a red bar? It's very hard. You'd have to take it all the way from 277.41 and take out 270.03. You know, that's a 2.5% move, right? Whereas this bar here is very small. You see, it's only a 0.46% bar. It's only a $1.28 sort of in height. So you can, you know, it takes a lot less to take out that range, and then begin to go after other people's stops. All right, so we'll leave it at that. I hope it's been useful for you to see sort of the explanation of the price action bar by bar of some of these bigger reversals, these more recent reversals. We talked about the importance of also looking at market internals, but a fun thing to do after this is to go back and look at other reversals. So go back and look at the really big reversals in the past. Depending on your platform, you may be able to get that historical data. But it's also very educational to go through there and have an understanding of what major turning points look like and what your strategy looks like during those major turning points. Happy trading. Take care.